YouTube channel. This is your F9 ACCA Financial Management teacher Naveed, and today what we are going to discuss is a question from Sources of Finance section of the syllabus, and this is called question GRENARP, right? And this question is also in BPP revision kit, and that will be question number 206 from 2017 revision kit, and this question is from June 2015. This question was also by some students, by most of the students I should say, that this was considered a bit technical, and in the exam pressure I would say that this is almost impossible to get full marks in this particular question, but you can take less than 8 marks. Like you can easily get 4 marks, which is 50% of the marks. That's all you need to pass the exam in a difficult question especially. So it's not that difficult to get 50% of the marks in this question, but to get full marks is slightly technical. But obviously this is a class and we have to get the right answer, so we can afford to spend some time on this question. So pause the video for a minute, read the question. I'll be also providing this question in the link below the video in the description, you can see, but right now pause the video, see the question, and then we'll discuss it together. Alright, so GRENARP, let's see the question requirement first. Evaluate the effect on the wealth of the shareholder. Evaluate the effect on the wealth of the shareholder of using net right issue funds to redeem some of the loan notes. So basically you are issuing rights, you'll have money, and you'll redeem some of the loan notes. So when you issue rights, the equity will increase, and when you redeem some of the loan notes, the debt will decrease. So the question is basically that what will happen to the wealth of the shareholder? Well, the wealth of the shareholder will change if the share price will change. So we will see what was the share price before and what will be the share price after the redemption. So now I'll read the question with you. GRENARP is planning to raise 11.2 million finance through rights issue. The new shares will be offered at a 20% discount, and the share price of the GRENARP, which is 3.5 per share currently, so the new share would be 20% lower, which is the right issue. That would be 20% less than 3.5. So 3.5 multiplied by 80% would be the price of the new share, which is basically 3.5 times 80% is 2.8. So the price of the right would be 2.8. The rights issue will be 1 for 5. So for 5 old share, every shareholder can get 1 new right. And the issue cost would be 280,000. So if you issue rights, you have to bear this cost of 280,000. Now we are given the balance sheet extract. We can see that current level of debt finance is 30 million, current level of equity finance is 85 book values, right? 8% loan note, so the interest rate is 8%, and 0.50 is the nominal value of the ordinary share. If you are using your BPP revision kit, then there is a typing error in that, and that is they have not given you the nominal value of $0.5, and also they have not given you 8% also. So if it is missing, then you can write it down. Okay, what else? The net cash raised by the right issue. This is the most important statement of this question. The net cash raised by the right issue will be used to redeem part of the loan notes issued. So once we issue shares, once we issue rights, we'll have money. We'll use that money to redeem some of the loan note, right? Some of the loan note, not all of the loan notes. So if part of the loan notes are redeemed, obviously we'll have different level of debt finance. We'll not have 30 million, then we'll have less than 30 million debt finance. each loan note has a nominal value of $100. So the nominal value is $100 and the market value is 104. So 100 is nominal value and market value is 104. A clause in the bond issue contract allows GRENARP, the company, to redeem the loan notes at 5% premium to the market price. So if you want to redeem your loan notes, it would be 5% premium or more than the market value 104. So 104 multiplied by 105% or 5% more or 1 plus 5% would be 104 multiplied by 1.05 is 109.2. So at this value you can buy back your loan notes, you can redeem your loan notes. At any time prior to the redemption value. Obviously if you want to redeem it before the maturity time, the maturity period, redemption date, then you can buy it at this price. The price earning ratio of GRENARP is not expected to be affected by the redemption of the loan notes. So PE ratio is not going to change. PE ratio. It also says that the current earning per share is $0.42. So this is our current EPS, earning per share, and the total earning, which is profit after tax. So EPS is basically profit after tax for one share, and this is your total profit after tax. And then it says that the company pays corporation tax at 30%. Okay, I'm not going to solve this question right now. I have already done it for you, and the only reason I did it before you was that I can show you the bigger picture of the question, so that it's a bit easy for you to understand. And if you think that I'm going too fast, then maybe you can pause the video and watch it again, right? So let's start this question, and this question is called question GRENARP from June 2015. So the question was, what will be the effect on the wealth of the shareholder? So effect on the wealth of the shareholder after redemption the loan notes. Effects on the wealth of the shareholder after redemption of the loan notes. Well, how can you find what will be the effect on the wealth of the shareholder? If you can find the new share price if we don't redeem it, and also the new share price if we redeem it, new share price if not redeemed, and new share price if redeemed. If you can find the difference of both of them, then this will give you the amount increased or decreased in the share price. So if the share price is increased, then it means that it's a good decision, and if the share price is not increased, then this is a bad decision, right? So we have to find new share price if redeemed first of all, then we will find the new share price if not redeemed. And in working number 1, we'll see if we redeem it, if we redeem some of the loan notes using the right issue, then what will happen? So working number 1, if you redeem it. So working number 1, we can calculate selling price using PE ratio and the share price using PE ratio, and the formula to calculate the share price is PE ratio multiplied by your revised EPS. What is revised EPS? Revised EPS is the EPS when after the redemption, the EPS after the redemption of the loan notes, right? So the current PE ratio could be calculated easily. As per our question, the current share price was 3.5 and the current earning is $0.42. So price earning ratio would be 3.5 divided by $0.42, and this would be our PE ratio, and then we have to find our revised EPS. Well, to calculate our revised EPS, I have drawn a diagram for you that you don't have to make it in the exam. Anything in red in this question, you don't have to write it in the exam. It is just for your understanding, right? In our question, the current profit after tax was 8.4 million, 8400,000 or 8.4 million. This is the current profit after tax. Well, if you have to calculate EPS, then the formula to calculate EPS, earning per share, is profit after tax divided by number of shares. After the rights issue, number of shares will change, and after the rights issue, because we'll have new finance, right, it means that profit after tax will also change. But you have to keep that in mind, that when you raise some cash from rights issue and then use the same cash to redeem some of the loan note, it means you don't have any extra cash left. If you don't have any extra cash left, then the PBIT will not change because of the finance. So what will happen? If we have our current profit after tax, and if you change that into profit before tax, if you add back the tax figure, again it will give you profit before tax, and then you will add interest also, this will give you profit before interest and tax. Then this profit is not going to change with our level of new finance, because we don't have any level of new finance. We issued the share, we issued rights, we have the money, and we paid back some of the debt, right? So we don't have any extra finance. So if you don't have any extra finance, the PBIT is not going to change. Why? Because PBIT is the profit that is not influenced by the way we finance our company. After PBIT, when you deduct interest and then you deduct tax, that will be different if we have equity finance or debt finance. So the PBIT after the new finance would not be different because we don't have any new finance. So once you have the PBIT, the old PBIT, then you can convert that into new profit before interest and new profit before tax. And once you have new profit before tax, you can calculate new profit after tax. And once you have new profit after tax, you can calculate your revised EPS, which would be revised EPS would be revised profit after tax that you just have calculated, and number of shares. I have explained the same thing over here also, if you can read that with me carefully. Rights issue will be used to redeem loan notes. Okay, therefore the amount of finance is not changed. Even after the right issue, we will have PBIT same as before. PBIT is not going to change. So once you have your profit after tax, you will change that into profit before tax. You will calculate your profit before interest and tax. Then you will change that into profit before tax, the new profit before tax, then the new profit after tax, and this is basically our plan. So we are going to start it now. So starting from our current profit after tax. As per our question, the current profit after tax is 8.4 million. So current profit after tax is 8.4 million as given to us by the question. And profit before interest, profit before tax into 1 minus the tax rate is profit after tax. So if you want to calculate profit after tax, if you want to calculate profit before tax, then profit after tax divided by 1 minus the tax rate would be equal to profit before tax. So profit after tax given to us 8.4 million divided by 1 minus 30%, which is 70%, would be equal to your profit before tax. So now you have your profit before tax. The third step is profit before interest and tax. So you add interest now. So profit before interest and tax now, which is profit before tax calculated above 12 million plus the interest rate. How do you calculate the interest rate? Well, profit before tax is profit before interest and tax is profit before tax of 12 million just calculated above, plus in the question the loan notes are 8% loan notes and balance sheet value is 30 million. So 8% of 30 million would be interest, the amount of interest, 8% of 30 million. This will give you your profit before interest and tax of 14.4 million. So we have done the third step also, profit before interest and tax. After that, you have to calculate your new profit before tax. So let's calculate our profit before tax, the new one, or the revised profit before tax would be a better word. Revised profit before tax is your PBIT minus your revised interest. Now what is revised interest? Once you have your rights issue, you have your funds from the rights issue, you will use it to redeem some of the loan note. So if you redeem some of the loan note, it will be decreased. It won't be 30 million anymore. It won't be 30 million anymore then if you redeem part of it. So you have to calculate now that what would be the new level of debt finance to calculate what is the new level of interest now. So we'll need to have a new working, the new level of debt finance, working number 3, new level of debt finance. Again, anything written in red, you can ignore it, and it's just for your understanding. It's not for the exam. It's just for your understanding. So don't ignore it, but don't write it in the exam. Interest paid is on nominal value. We all know this. We pay interest on nominal value. All right. When new debt is redeemed, it will be reduced. The level of debt finance will be reduced. Okay, cash raised from the rights issue will be used to redeem the loan notes. When we raise cash from rights issue, it would be used to redeem some of the loan notes. Therefore, the amount reduced in the debt finance be equal to the cash raised from the right issue. The cash raised from the right issue would be equal to the amount redeemed. The debt finance, the level of debt finance redeemed would be equal to the cash raised from the right issue. So we have to calculate first what is the cash raised from the right issue. Cash raised from the right issue would be equal to number of rights multiplied by the issue price. This will be the cash raised from the right issue, obviously minus the issue cost, because our questions say that if you want to raise finance using right issue, then you have to bear some cost of 280,000. So the issue price in our question we calculated over here, and it was 3.5 is the current share price. So 20% lower than that would be 2.8. That would be the price of the right. So 3.5 multiplied by 80% is 2.8, which is the price of the right, and number of rights is obviously 1 for 5 rights issue, so 1 for 5 multiplied by the old number of shares, and old number of shares in our balance sheet is 10 million divided by 0.5, 10 million divided by 0.5, which would be 20 million shares, old number of shares. So if old number of shares were 20 million, then the new number of shares will be 20 million divided by 5. So 1 for 5 multiplied by 20 million multiply by 2.8 minus 280,000 would give us 1092000, which is 10.92 million, and this is the cash raised from the right issue. Once you have cash raised from the right issue, we said that this amount would be used to redeem the loan notes. So the number of loan notes redeemed would be 10.92 million divided by the cost of one loan note. Can you calculate the cost of one loan note? Well, it is given to us. Actually, we have done it here. That market value is 104 and it would be redeemed at 5% premium. So one loan note would cost us 109.2. So if you redeem that, if you divide that by 109.2, or I have done it again over here, this will give you 100,000 loan notes redeemed. So the number of loan notes redeemed would be 100,000. Now what is the nominal value of the loan notes that we will redeem? Because we pay interest on the nominal value. So the nominal value of 100,000 loan notes, well, the nominal value of one loan note is 100, so the nominal value of 100,000 loan notes would be 10 million. In our question, we were given this, that the balance sheet value here is 30 million, and if you redeem 10 million, we will be left with 20 million. So 30 million we had the debt before, and we will redeem 10 million, so we will be left with the nominal value of 20 million. So the new interest would be at 20 million loan notes. Okay, sorry, I paused the video. So the new debt finance would be 20 million. It used to be 30 million before, now it is 20 million. So now we will pay interest on 20 million only, we will not pay interest on 30 million. So going back to our question, when we had to find the revised interest rate, then we have to multiply it with the new level of debt, 20 million, that we have just calculated. So 20 million debt and the interest rate was 8%. So your revised profit before tax would be your PBIT 14.4 million calculated above minus the revised interest rate, which is on 20 million now, not on 30 million, and this will give us our new revised profit before tax. So our revised profit before tax would be 12.8 million. So let's go back on what we were doing above. What is the plan? Basically, we started from current profit after tax, then we did current profit before tax, then we did profit before interest and tax, and now we have calculated new or the revised profit before tax, and after this we will calculate new profit after tax. So this revised PBIT will be converted into profit after tax. So therefore revised profit after tax would be your profit before tax 12.8 million minus 1 minus the interest rate into 1 minus the interest rate, and this will give you 12.8 million multiplied by 1 minus 30% is 70%, and your revised profit after tax would be 8.96 million. And then we have to calculate your revised EPS, and your profit after tax is 8.96 million divided by the number of shares. Well, the number of shares as per our question, the old number of share as per our question, we just said that it is 20 million, and 145 rights issue, so the right issue are 5 times smaller than the old number of shares, so right issue is 4 million. 20 divided by 5 would be 4 million. So overall the new number of shares after the right issue would be 24 million, and this will give us a revised EPS of $0.373. If the revised EPS is $0.373, then what would be the share price? And as we said in the start of the question, we said that the new share price, if redeemed, is PE ratio divided by multiplied by revised EPS, which is 0.373, and the price, the current share price is 3.5, the current earning per share is 0.42, and the new share price if not redeemed would be $3.11. Alright, so if we do not redeem, then we'll have a share price of 3.11. So we'll write it over here, and I'll use this time blue. So 3.11 is the share price if we do not if we redeem, right? Now we have to find out the share price if we do not redeem over here, and then this will help us in our conclusion that the wealth is increasing or decreasing. So this would be calculated in the next working 2. So now working 2, share price if not redeemed, share price if we do not use the cash raised from right issue to redeem our loan notes, part of the loan notes. Well, if we do not redeem the loan notes, it means the level of debt finance is not changing. Okay, and if the level of debt finance is not changing, the only thing that is changing is equity finance. Equity finance is increased. So if you issue rights and your equity finance is increased, the price after the rights issue is what we call theoretical ex-right price. So if we do not redeem the loan notes, the share price would be theoretical ex-right price. And if you calculate your theoretical ex-right price, well, is basically the weighted average of the old share price and the new share price, and old number of share and new number of share. And as the question says that is 145 rights issue, it means if you have 5 old shares, you will get 1 new share. And if the share price of the old share is 3.5 as per our question, and the share price of the new share, the new right, well, we said the share price should be 20% lower than the current share price, which is 2.8. But we should not forget that there is issue cost of 280,000 also, which will affect the price of the right also. You have to charge this cost to each share, right? Well, again, I'll just say don't get it right in the exam. Don't have to get it right in the exam, right? Get it wrong. But don't worry about getting it 100% right, right? Because you will not get it right anyway in the exam. Like, not the exact answer, you cannot get it, right? It's very, very difficult, right? So, if the current share price is, if the right is, as we calculated on our question paper, we said that it is 2.8, but if you charge the issue cost of 200,000 on 4 million rights, 145 multiplied by 20 million old shares, then this would be 4 million. So if you charge this to 4 million rights, then we have to charge $0.07 to each right. So 2.8 would be reduced by 0.07, and that would be 2.73. So the issue price of the new right would be 2.73, and if you calculate the weighted average, the theoretical X right price should be $3.37. So if you do not redeem it, the share price would be 3.37. So if you do not redeem it, the share price would be 3.37. Now if the share price, if redeemed, the share price would be, if redeemed, the share price would be 3.11. If not redeemed, the share price would be 3.37, and if you calculate the difference, that would be 3.37 minus 3.11, and that is equal to 0.26, right? And that is basically what the wealth is going to decrease by 0.26 per share, right? So if you use it for redemption, the amount is used for redemption, the wealth is going to decrease by 0.26 So then you have to write it in the conclusion that 3.11 minus 3.37 is decrease of $0.26, and the wealth will be decreased, not increased. Wealth will be decreased by 0.26 per share if the right issue are used to redeem some of the loan notes. Let's do a quick recap. The question was that you should issue the rights when you have the money, then you use it to redeem some of the loan notes. Should you do it or not? Well, you should do it if the wealth is going to increase, and you should not do it if the wealth is going to decrease. So the share price if redeemed minus the share price if not redeemed, and first we calculated the share price if redeemed in working number 1, and then we said that the price earning ratio multiplied by the revised EPS will give you the share price if redeemed. Why the revised EPS? Because the interest level will change, and because of the interest level the profit after tax will change, and if the profit after tax will change, then EPS will also change, because EPS is profit after tax divided by number of shares. So now you have to calculate revised EPS, and for that you said that the current profit after tax is this given to you, and you change that into profit before tax, and you change that into profit before interest and tax, and then you deducted the new interest from it, and you calculated profit before tax. Then you calculated profit after tax, adjusted the profit before tax figure with tax, and this will give you your revised EPS. Once you have your revised EPS, so here we have calculated your revised EPS. Once you have your revised EPS, then you can calculate your share price. So So you have calculated the share price if not redeemed. If redeemed, sorry. Then you have to calculate your share price if not redeemed. And we said that this will be theoretical ex-right price, and it was 3.37. And if the share price has decreased, then it means that we should not use it to redeem the loan notes. Alright guys, I hope it was helpful, and you can join my online classes if you want to. This is my phone number. You can contact me anytime you want. So this is my phone number, my email address. Well, my email address will be given to you in the description below, right? So if you have any issues, you can contact me on this number, and if you want to join my online classes, then you can contact me too. Thank you very much. Good luck.